Hey, in this video we're going to talk about crypto taxes. This topic is on the minds of many crypto investors around this time of year, and if it isn't on your mind, it should be. In this video you'll find out how to pay your crypto taxes, the biggest misconception about crypto and tax, when you need to pay tax on crypto trading, income, airdrops or NFTs, and what you need to know if your crypto exchange went bankrupt in 2022. Let's dive in. First of all, if you think because you own crypto you're anonymous, think again. Many people like crypto because it's decentralized and unregulated, but actually it's becoming more centralized and more regulated, and the IRS can find out everything they need to know about everyone's crypto activity. All your activity is permanently stored on the blockchain, and many crypto exchanges report to the IRS. If you've gone through KYC on an exchange, if you withdraw coins to your bank account, your transactions are not anonymous, especially if you're dealing with large sums. So if you're thinking of screwing the system, think again. Now there are ways to remain anonymous in crypto, but you need to set things up in a very specific way, and we don't recommend doing it, especially for any kind of tax evasion. So let's move on. So how is crypto taxed? Well, the IRS considers crypto as an asset, a bit like stocks or other investments, which means that it's subject to capital gains and losses. So when you sell your cryptocurrency for a profit, you'll owe taxes on that profit. For example, you've bought one Bitcoin at 17k, well done. But let's imagine you sold at 25k, that's a 47% gain. Nice. But because the IRS treats crypto as property, this 47% difference is taxable, just like with any other investment like stocks, for example. The same goes for exchanging one cryptocurrency for another. For example, if instead of selling your Bitcoin you exchange it for Ether or a stable coin, or if you pay for something in crypto. On the other hand, you don't always make a profit, but if you make a loss, at least you don't have to pay any tax. This is calculated on the net total of all transactions that year. If you sell crypto assets with a total gain of $10,000 but sell a bunch of others at a $15,000 loss, this means you have $5,000 in capital losses. You can deduct up to $3,000 a year in capital losses and are allowed to carry over losses above this limit to future years. Another thing to keep in mind is that if you hold your cryptocurrency for longer than a year before selling, you'll be eligible for long-term rates on capital gains, which are typically lower than short-term rates. Okay, that's with regards to trading crypto, but what if you receive crypto as payment for goods or services? In this case, it's considered income and is subject to income tax. The same applies if you get coins as an airdrop. The amount you owe will depend on your income tax bracket and your filing status. So if it's income, it doesn't matter if it's crypto, dollars or pesos, the same rules apply. Same if you get income from mining or staking, or you get interest on your crypto account. And if all that wasn't enough, if you create and sell NFTs, it's currently not much different, but the IRS is planning to treat NFTs as collectibles, which means they'll be taxed at a higher rate, like art or gems. The IRS figured, well, they're one of a kind, so why not charge more tax? Now let's talk about how to calculate your crypto taxes. First, you'll need to determine your cost basis, which is the amount you paid for your cryptocurrency. Luckily, this includes any fees you paid to purchase it. Then, when you sell your cryptocurrency, you'll need to subtract your cost basis from your sale price to determine your capital gain or loss. It's important to keep detailed records of all your cryptocurrency transactions, including the date of purchase, the purchase price, and the sale price. This will make it easier to calculate your taxes when the time comes. Otherwise, if you have your crypto on an exchange, you can generate a statement with all the transactions. One thing to keep in mind is that cryptocurrency exchanges are not required to provide you with a 1099 form, which is the form used to report income from investments. This means that it's up to you to report your cryptocurrency transactions accurately on your tax return. There are services like Coinly and CoinTracker that help you keep track of your transactions and calculate your taxes. Finally, what to do if your crypto exchange went bankrupt in 2022. It's estimated that over 1 million people may have lost their money in the FTX collapse, and there's not much you can do about that. When the bankruptcy gets finalized this year, we'll know more about the losses and the types of deductions people can get. It's also possible that some users may be able to get some of their money back, but it's too early to tell at the moment, just like if you had assets tied up in a normal company that has filed for bankruptcy. so you'll have to wait. In conclusion, understanding how crypto is taxed is an important part of being a responsible investor. The IRS views crypto as property or a digital asset or income, so every time you sell or exchange your crypto or get paid in crypto, it's a taxable transaction. Make sure to keep accurate records of all your transactions, and if you're unsure, it's always a good idea to consult with a tax professional so you avoid any unpleasant surprises from the IRS. Hopefully this has been helpful. If you have any questions or comments, please feel free to leave them in the comment section below, and don't forget to subscribe to our channel for more videos on money and investing. All the best and see you soon.